Something serious is happening in bonds, and it's not getting the attention it deserves. After Moody's downgraded U.S. credit outlook, Japan's 40-year bond yield surged to its highest level in over 20 years. Prime Minister Ishiba went as far as calling the situation worse than Greece, all while Japan's GDP is contracting again. Back in the U.S., bond yields are spiking. The 10-year Treasury hit 4.5%, and the 30-year soared to 4.98%, big moves that signal investors are dumping government bonds. Why does that matter? When bond yields spike, borrowing gets more expensive for everyone, from governments to homeowners. It reflects fear of persistent inflation, exploding debt levels, or interest rates staying higher for longer. These are warning signals, not background noise. Take Bank of America. It's sitting on $700 billion in bonds bought during 2020 when yields were just 1%. Today, those bonds are down 40%, hiding around $100 billion in paper losses. Losses that aren't visible on the balance sheet because they're classified as held to maturity. Meanwhile, the U.S. Treasury has to refinance $9 trillion dollars and issue another $0.5 trillion dollars in new debt. But foreign buyers, especially China, are pulling back, selling treasuries and buying gold instead. If Trump returns and disrupts the already fragile debt recycling system, we could see failed treasury auctions or more quantitative easing, both of which would send inflation soaring again. If bond yields rise to 7% or 10%, Bank of America's equity could be wiped out, and we'd be staring down a systemic failure of the fractional reserve banking system, something we haven't seen since 1932. And then there's Warren Buffett. He's been selling large chunks of Bank of America stock. Coincidence? Or is something deeper brewing? The bond market isn't just flashing warnings, it's shouting them. Keep watching. Thanks for tuning in. This is The Fellow Investor.